Welcome to this urgent explainer. We're breaking down a massive structural shift happening right now in the 2026 vintage and luxury watch market. If you own a luxury watch, or you're even just thinking about pulling the trigger on one, you've got to understand exactly what's going on, because the rules of this market are being completely rewritten. Let's jump right in and tackle the absolute biggest fear for collectors right now. You've probably seen the doom and gloom headlines, right? The idea that the entire market is just collapsing. But we need to separate the noise from the actual hard data. Is the luxury watch market really crashing? Well, to figure that out, we have to zoom out and look at the broader picture of how this specific market moves. And this macro timeline perfectly illustrates how we got here. We move from an unprecedented boom straight into a short 30 to 40% drop, which leads us directly into today's market normalization. We're sitting right here in the 2026 normalization phase, but honestly, you can't wrap your head around this current reality without looking at the absolute mania that kicked it all off. Let's rewind to that perfect storm between 2020 and 2022. The pre-owned watch market went completely ballistic, experiencing something we've literally never seen before. People were stuck at home, pandemic savings were surging, and we were living in a zero-interest rate environment. Add to that a massive explosion in social media watch culture, which brought this huge wave of younger buyers flooding in. Suddenly, these weren't just timepieces anymore. They were aggressively traded, highly liquid assets. And man, the whole world noticed. Just to put the peak of that mania into perspective, a standard $40,000 retail stainless steel Patek Philippe Nautilus was trading hands for over $250,000. Seriously, think about that for a second. We were seeing $9,000 Rolex Submariners instantly flipping on the gray market for 25, 30, even 35 grand. It was, without a doubt, a completely unsustainable peak. And then the correction hit. And it hit hard. By mid-2022, the free money party abruptly ended. Interest rates shot up, discretionary spending tightened, and the crypto markets, which had been fueling a ton of this speculative buying, just totally collapsed. Also, to their credit, Rolex dramatically increased their factored production. More watches hitting authorized dealers meant way fewer desperate buyers running to the gray market to pay those insane premiums. So, here is the absolute crucial point. All that speculative froth, it's been cleared out, but the underlying market structure remains deeply resilient for the informed buyer. This correction we saw deepen into today was completely necessary. As industry veterans have been pointing out, this isn't a crash, this is a market returning to reality. And in reality, that is exactly where the real opportunities exist. When we survey the 2026 landscape, we're seeing a really stark divergence. It's almost like looking at a financial terminal. The benchmark Rolex models are softening as those gray market premiums erode. The ultra-luxury tier, like Patek, is stabilizing after the extreme peak cooling. Meanwhile, vintage Seiko is rising fast based on its undervalued history. And former hype kings like Richard Mille are actively falling as that hype-driven demand unwinds. Let's break these segments down one by one. Section 1. Rolex and ultra-luxury. The benchmark normalizes. Let's look at the iconic Rolex Submariner. Those massive 50 to 100% gray market premiums of the past have drastically compressed to a much healthier 10 to 20% margin. This marks a far better entry point for patient buyers. Now sure, references like the Submariner are still trading above retail in the secondary market, but the fundamental demand hasn't disappeared at all. It's just normalized to a totally sustainable level. Meanwhile, at the ultra-luxury tier, Patek Philippe and Audemars Piguet are stabilizing post-hype, proving that 50 years of true horological pedigree doesn't just go to zero. The Nautilus and Royal Oak have finally come down from the stratospheric highs, which is actually creating a genuine window to acquire pieces that were basically inaccessible a few years ago. Long-term holders of these references are still sitting in profit over any 5-year horizon. What 2026 presents is a real window to buy before the cycle shifts again. Section 2. The rising tide versus the losers. Shifting collector demographics in 2026. The stark reality right now is essentially a tale of two very different markets, hype versus heritage. Status symbol watches bought purely for hype, like Richard Mille and Hublot, are facing painful corrections. They were speculative buys, and they're unwinding rapidly as social media cachet fades. On the flip side, we have heritage. Vintage Seiko, Omega Seamasters, Cartier tanks. This is genuine horological history that is experiencing a massive, sustained reevaluation by a younger, highly educated demographic. Make no mistake, the market is brutally punishing specific brands right now. It all comes down to this concept of hype vulnerability. This is the principle that watches bought purely for social status, lacking genuine horological merit or brand heritage, are the absolute most susceptible to severe price crashes when market sentiment shifts. It's an age-old lesson about the real dangers of buying into transient trends. Conversely, take a look at the vintage Seiko 6139 Pogue. A watch you could easily find for $300 5 years ago is now regularly commanding well over $1,000. Younger collectors are waking up and realizing that Japanese watchmaking is just grossly undervalued. This isn't some speculative bubble, folks. This is a market finally discovering and pricing in the real historical significance and incredible engineering of these pieces. Section 3, the 2026 Investment Playbook, positioning yourself in a normalized market. So zooming back out, how should you position yourself? Well, when compared to other alternative assets, watches remain incredibly favorable. Unlike art, they're portable, wearable, and globally liquid. You can literally wear your investment to dinner. Unlike classic cars, they require minimal ongoing maintenance, no $10,000 engine rebuilds here. And unlike crypto, the best vintage watches give us 100 years of real pricing history to study and rely on. And according to the Mimosas Luxury Investments Index, top-tier Rolex, Patek, and AP pieces have actually outperformed the S&P 500 over any 20-year rolling period. While past performance is obviously never a guarantee, the structural fundamentals, driven by finite supply, increasing global wealth, and a continuously growing collector community, prove that the best watches hold their ground remarkably well against traditional financial markets. If you're going to put money into this market right now, you need to ruthlessly adhere to 3 foundational buying principles for 2026. 1. Buy to watch, not the hype. Focus on iconic designs and pioneering movements. 2. Condition is absolutely everything. An unpolished piece with full documentation wins every single time. And 3. Buy at the right tier. A $1,000 heritage Seiko with rising collector interest beats a hype 10x piece hands down. The market is currently rewarding patience, deep knowledge, and actual taste. Ultimately, the 2026 vintage watch market is not in crisis. It's just in transition. The money is finally following the people who actually love the heritage of horology. As the speculative froth clears out and the smart money starts circling again, take a look at your own wrist and ask yourself, in the long run, are you buying the hype or are you buying the history? Drop your market take in the comments below, and I'll see you in the next explainer.